If you're looking to buy your first home, it can be quite difficult to know where to start. So we always recommend sorting your finances first, because if you were looking to buy anything else, you wouldn't go out without knowing how much you're going to look to spend. So what's the point going to look at properties without knowing your maximum budget? So in this video, we're going to be talking through how to get a residential mortgage in the UK. Hi, this is Sam from Rosehill Financial Services. If this is your first time watching us, I hope you do find our content useful, and please do share with anyone who may benefit from watching these videos too. So we're going to look at three of the main factors involved when it comes to getting a residential mortgage in the UK. Of course, there are other factors that will be involved, but it's best to speak to a broker in detail so that they can advise you on your specific circumstances. So first up will be your affordability, where lenders will take into account your income and committed expenditure. Lenders in the UK will assess your income in different ways, especially if you're self-employed. Many lenders will look at the latest 2 to 3 years accounts and will generally want to average the latest 2 years. So if you're a limited company director, that will be your salary and dividend figures, and then for a sole trader, that will be your net profit from self-employment. But some lenders will be able to take your latest year's figures and maybe even your first year's figures. So it's always best to speak to a broker so that you know where you stand. Now, if you're a limited company director and you tend to keep more profits in the business, then another potential option for you would be a lender that will allow you to use your net profits plus your salary. In some cases, this could be the more suitable option for you and allow you to borrow more. So when it comes to committed expenditure, lenders are going to be looking at everything from credit card debt, personal loans, car finance, utility bills, childcare cost, and the list goes on. So if you have higher committed costs each month, lenders generally tend to lower the maximum amount that they're going to lend you. Now, this is to make sure that they're lending responsibly so that you can keep up your mortgage payments going forward. Lenders may also limit the maximum amount that they're willing to lend you based on the amount of dependents that you have. So this could be children, or it could be elderly relatives that are financially dependent on you. Now, to give you an example, if you're self-employed and you've had consistent earnings of around 40 grand each year and you've got minimum to no debt or committed expenditure, then a good starting point would be around 4.5 times your income. Now, this can be higher with some lenders or it can be lower with others, but to give you a good sort of ballpark figure, that's a good sort of starting point for you. For the purposes of this video, we're going to keep it nice and simple. So on this basis, this would leave us with about 180 grand's worth of lending. But if you had any dependents or debts or committed expenditure or even adverse credit, then this amount may be reduced. So the second factor we're going to talk about is your credit file. Now, most lenders will use either Equifax or Experian to check your credit file, and they're basically going to be looking at this to ensure that you're spending responsibly. They'll also want to see that you're on the electoral roll at your current address. So it's quite important to make sure that you are, as this can result in a fail on an agreement in principle. If you'd like to know more about agreements in principle, we have made another video on this which goes into more depth. We're not going to go into this in this video because otherwise the video would be too long, but do go and watch that if you want to learn more about that too. So for all the details that we enter on your mortgage application, the lender will be checking your credit file to make sure that these details add up. So this could be anything from credit card debt to loans or car finance, whichever it might be. Lenders will also use this credit check to look out for any adverse credit on your file. So this could be any sort of missed payments on credit cards or loans, for example, or it could be county court judgments, and the list goes on. Again, we will make another video that goes into your credit file in more detail and what to sort of look out for. You may find it's worth checking your affordability and your credit file with your broker so that they can go through in detail and sort of point out anything that sort of seems out of the ordinary or would be picked up by lenders, and then they can advise you on your specific circumstances. So the last thing we're going to be talking about today is your deposit. So the deposit is the cash amount that you're going to be putting towards buying your new home. So it'll be the difference between the purchase price and the loan amount. In most cases, you'll need a minimum of a 5% deposit with lenders, but but this requirement can be higher with some lenders depending on your circumstances. At the 5% deposit range, you may find that there's a limited amount of lenders that are available to you, and you'll generally find that the interest rates are a fair bit higher when compared to a 10% deposit or above. Some lenders may also limit the maximum loan amount available to you based on you having a 5% deposit. We generally recommend going in at a 10% deposit or above if you can. So generally speaking, up to a certain point, interest rates are going to decrease at every 5% increase in your deposit. So usually 10% deposit will get you lower interest rates than 5%, 15% will get you lower interest rates than 10%, and so on and so forth. So when working out the maximum deposit you have to put towards your purchase, you're going to want to take into account the other costs involved in the process as well. So this could be anything from your stamp duty fees to solicitor fees to arrangement fees and valuation fees with the lenders, which apply to some products, any broker fees involved, any furnishing costs for the new property, any private valuations that you want to have booked in, and the list goes on. Once you have a rough total figure set aside for all of those costs, we always recommend adding a little bit to this as well, just to sort of cover any unexpected costs that may arise. Now we are going to be going over these costs in another video in more detail, but for the purposes of this video, it's just to highlight 3 of the main areas involved in getting a mortgage in the UK. As I always say, preparation is key when it comes to buying your dream home, so be sure to speak to a great broker early into the process to understand your maximum borrowing and all of the costs involved. Now if you'd like any further information, please don't hesitate to leave me a comment or drop me a private message and I'll be happy to help. Now before we finish up on this video, I am obliged to tell you that your home may be repossessed if you don't keep up repayments on your mortgage. So just to summarise, 3 of the main factors involved in getting a residential mortgage in the UK. You've got A, your affordability, so your income and committed expenditure. B would be your credit file, so that the lenders will look for any adverse credit and they'll also look for sensible spending. And then you've got your deposit, so the amount of deposit that you put towards the purchase. Generally speaking, the lower the interest rate will be. Thanks for watching, guys. I hope you found this content useful, and I look forward to bringing you more content in the future to help you secure your dream home.